Well, 8.2 million. That's how many fewer workers our economy has following this pandemic. You'd expect that to slow things down, yet productivity is booming. Steve Leisman is here with more about that. Steve?
Hey, Kelly, yeah, it is an astonishing fact of the pandemic. Output from the U.S. economy has now topped the level from before the pandemic, but with 8 million fewer, 8.2 million to be precise, fewer workers. It's a result of booming productivity that several economists believe will outlast the pandemic, and that's good news for workers and corporate profits. The sources of the productivity boom, well, you've heard them. More e-commerce, that's going to stick around. Work from home, that's going to stick around. Doing more with fewer workers, better business processes, and of course, some creative destruction. Productivity normally booms after recessions. Unproductive businesses close. That's the creative destruction part. And often the least efficient workers are let go. But then it comes back down to earth as the economy normalizes. The difference this time, new technological advances and ways of doing things like virtual real estate sales and work from home, they're not seen going anywhere. In fact, a paper by 3 researchers, including Stephen Davis from the University of Chicago, it concluded after 30,000 interviews of workers and employees about working from home that, and I quote here, much of the COVID-induced shift to work from home will stick long after the pandemic ends. We project that American workers will supply about 20% of full workdays from home, 4 times the pre-COVID level. There are positive impacts potentially for the stock market too. Barry Knapp from Ironside telling me he doesn't think all this is factored in, and earnings estimates may have to rise in the months ahead. What are the results? Well, you can get higher wages from better productivity, higher profits as well, increased potential GDP growth, slower employment gains as it's a little harder to put some of the workers back to work, but also this challenge is the high inflation story. Work from home, Goldman Sachs says, has mobilized part of the household capital stock, home offices and computers for business purposes, much like what Uber and Airbnb did for cars and second homes. Now, a lot of these technologies, hey, they were around before the pandemic, but the crisis has shown that necessity is the mother, in this case, Kelly, of adoption.
It's fascinating. Stephen, stay right there because we're going to speak more about this with David Zervos himself. I know you're talking to about his views on all this. I especially want to spin it forward and look at what this economy might look like in the next 6 to 12 months. Dave, welcome. Dave's the chief market strategist at Jefferies. And I guess before I kind of get into the big picture, I want to make sure our viewers have a sense, Dave, of where these arguments are pointing in terms of market impact. All of this is paving the way for what kind of stock market and bond market for the time being, do you think?
So I think Steve alluded to a lot of this in his opening discussion, but a lot of this is just, it's very good for corporate profits. It's actually good for wages. It's a bigger pie to share. How that gets split up between capital income and labor income is debatable. But I think what we proved between Q1 of 2020 and Q1 of 2022 is that we can produce basically at or more GDP with, on average, about 8.5 million during the quarter workers, 8.5 million less workers. And it's an astounding fact. And it's got a good side and a bad side. The good side is, wow, we're really productive and we really adapted to this world where we went to less labor-intensive businesses. And the other part is, well, okay, what are we going to do with the fact that we've got a pretty serious unemployment problem still, right, and a lot of those jobs may not come back?
But here's what I find very interesting to ask both of you. So, Dave, I'll start with you. We are about to see this all slow down and change, though, aren't we? I mean, a portion of this will last, but the rest of the part that we're getting productivity gains from is from closed down parts of the economy that the public doesn't actually want closed down. They want to go to restaurants. They want to go to stores. They want to go to, the summer carnival. They want to go on cruise ships. They want all of these things that weren't operating in the pandemic are about to come back online in a big way. Isn't that going to increase the labor force, slow productivity, and reverse some of what you're talking about?
It may, but you also have to juxtapose that with what businesses that adapted to an online business model and reinvested in more of an online business model are going to do going forward. Are you going to build more showrooms if all of a sudden everything went virtual for your car sales, for example, or whatever big ticket item you were doing? I think the big question, and I don't want to dismiss what you're saying, there's definitely going to be a few million jobs probably added back that come into retail and hospitality. And again, those are going to be less productive because they're just more labor-intensive jobs. But what we really did is we had a recession, and as Steve said, productivity goes up after recessions. But we had a recession because we decided, or we had to we had to decide to do things with less people or less interaction. And what that caused us to do was really innovate in the less interactive ways, all of these businesses. And I think that is much more here to stay than maybe people are thinking in the future. And it really portends a very different outlook for how a number of businesses outside of leisure and hospitality, whether it's financial services or whether it's transportation services or whether it's any form of goods production as well, it just means that more of a online or more of a virtual or a less labor
less in the real world. Yeah.
will hold in the boardrooms.
Kelly.
And I think that's going to be a big difference in how this labor market bounces back.
Steve?
Yeah, so the Dark Ages were characterized by the loss of technologies from the Roman era, from the Roman Empire. We're not going to enter the Dark Ages here. We're going to remember the things we learned from the pandemic, and we're going to hold on to them because they're profitable and because they're efficient and because we live better with them. If you can do the job without the commute, well, you're going to do the job without the commute. If part of the job involves some commute, well, that's fine too. And the amazing thing, Kelly, is we don't need a lot of extra productivity to live a whole lot better. Remember, productivity moves along at 1.5%. Job hours worked grows by 0.5%. So potential is somewhere between 1.75 and 2. If we can hold on to 0.5 point or even a point of that extra productivity, we're all going to live a lot better. It jumps up potential GDP to 2.5, maybe 3%. That's a big jump.
It is. It's huge. It's a wonderful thing, as long as you kind of eventually get all the rest of those jobs as productive, I guess, as you would say. But Dave, before we have to go, I want to ask you about something else that kind of underpins all of this. It's inflation. And it's striking to read your notes at a time when most people out there in the world are screaming about hyperinflation and sell your bonds and short your bonds and bond yields are going up and the Fed's going to let it run hot and all of these things. I want you to tell everybody why you're happy to buy every single bond that they want to sell. Okay, maybe once we get over 2% on the 10-year.
Right. I'm not happy to buy them here. I don't think they offer a lot of value. I've been telling our clients that since the beginning of the year and since we vacated some of our standard risk parity strategies of last year, the whole decade. But let me just say, I think it's amazing that we had a core CPI print, which was the highest in nearly 40 years, and the bond market can't sell off. You got to think about it. The highest core monthly print in 40 years, since September 1981, when the bad old days of stagflation were there, and the bond market is kind of stuck in the mud.
Is that because of the Fed? Is that people, the critics will say it's
Kelly?
all because the Fed is buying?
Well, go ahead, Steve.
No. I was just going to say very, very quickly that, Kelly, can you imagine the real disinflationary and deflationary forces in the U.S. and the global economy that we can't move the bond market with massive fiscal spending and massive Fed easing out there? That tells me that there's a lot of things
the inflation is slowing the economy to some extent. Dave, I mean, is that part of your view that when you have price hikes and shortages and things like this that are sort of resulting from the pandemic, that can act as a brake? Look at what's happening in the housing market.
People are going to substitute out. If oranges go up, they buy more apples. If steel goes down, they're going to buy more of that relative to lumber. We've heard, people say it's cheaper to build with steel than lumber now, which is obviously not going to last. But again, I think more importantly than all that is that the market is not really buying into some hyperinflationary story. There's a lot of guys that love to come on and talk about it, and they preach the end of fiat currency and they preach the end of the Fed, and they want to tell us why the Fed does such a terrible job when actually the unconventional monetary policies are really the only reason we got out of the last 2 recessions. But in general, I think people just aren't putting their money where their mouth is. They're scared. They've been beaten up. The inflation bets, the big inflation bets that have taken place over the last 3 decades, not just even the last decade, going back to the 90s, have all been losers.
All right.
And so people are a bit gun shy. And I get that. I hope we get some big inflation prints. I want to take bond yields up north of 2% to 2.5%. I want to have a lot of rate hikes priced in for the next 5 years. And then I want to go back to my standard risk parity trades where I have value in the fixed income market. And people can actually do their 60-40 bond trades again. And mom and pop have a way to have a safe asset that isn't zero or negative yields.
Yeah. So, Steve, I'll give you the quick last word on all this.
I think David has it right. The idea, and by the way, it's not inflationary if inflation slows the economy, because then prices would fall and the economy would slow down. The real danger here is some form of stagflation, which is not what I think is going to happen. I think this productivity boom is something to watch. It creates winners and it creates losers. And I think investors have to be careful on both sides of that equation. Some folks are not going to be winners in this productivity boom. There's equipment to be sold, but also some equipment, some industries are not going to end up on the plus side.
Well said. Fascinating. I know some days I think I'm on one side of this conclusion-wise, and then other days I'm on the next. Maybe everyone in the market knows how that feels. Dave Zervos and our own Steve Leisman, thank you both very, very much.
Shepard Smith here. Thanks for watching CNBC on YouTube.